Chapter 4, Risk Assessment. Okay, the auditor's risk assessment process. Right, this is figure 4.2 in your book. Okay, we're going to assess business risk and the risk of material misstatement. Okay, audit risk is the risk that an auditor expresses an inappropriate audit opinion when the financial statements are materially misstated. Okay, and I'm going to tell you the definition of all the risk. Okay, the engagement risk is an important risk. This is a risk we were discussing with Olympus. The auditors, their engagement risk, not certain if they actually evaluated their engagement risk properly. The engagement risk is the risk that the auditor is exposed to financial loss or damage to their reputation based on some litigation, some adverse publicity, which is what happened with Olympus, and anything else that arises in connection with the statements that they audited. Audit risk is the risk that an auditor will issue an unqualified opinion on materially misstated financials. Okay, but the engagement risk is our loss. Okay, so remember the difference in the two. Okay, so we perform a risk assessment. So we inquire of management, we do analytical procedures, and we do an observation or an inspection to understand the business itself and its environment. The environment piece is going to be their industry. Okay, so we inquire of management and other personnel. Remember, we were just interviewing other personnel to see, if they were going to tell us anything or if anything seemed a bit odd or what have you. And then, of course, we talk to people outside, like the bank, like the predecessor auditor, etc. We do analytical procedures, which means we actually do a test, and one of those tests is going to be to compare outcomes for this particular business to their industry. Observation and inspection, we're going to do a walkthrough through the company. Okay, in understanding the company and the industry, we have cumulative knowledge and experience obtained from prior audits. We will go out and talk to predecessor auditors. So if they've changed auditors a lot, or if they've had an auditor that's been around a while, we will inquire about previous audits and their opinions and how they arrived at that opinion, etc. Our procedures performed in the client acceptance. So when we go through and we look at the client and we assess a business risk level to them and what we had to do to get the information, if we had to beg the client to give us information, to give us permission to talk to predecessor auditors and outside people, that could be a red flag. Any knowledge that we obtain during our walkthrough and observation, or any testing that we decide to do. Our discussions with the management is primary in determining how well we understand what's going on with the company. We read the minutes of board meetings, which generally, unless they're a special meeting, they are scheduled, so it won't be difficult to do that. Some have a quarterly meeting, some have a semi-annual or annual meeting. We will get those minutes and read those. We will look at their budgets. We will look at their projections for revenue. We will look at stock changes, if there were splits or anything like that, and the reason why. We will look at new financing that they've done and why, talking to the banks, etc., etc. Okay. All right. So we determine what the nature of the entity is. We look at their industry. Okay. We look at the internal controls for both the business and the industry. Are they similar? Is this client doing something extremely different from others in their field, etc.? We will look at their objectives, especially their budgets and their revenue projections, and then what their performance measures are. Remember, we'll look at management differently from an integrity perspective if they are always struggling to make bottom line projections, because that is going to give us a red flag that we may need to do more testing in the revenue area. And that's just a repeat. Okay, industry, regulators, and other external factors, industry conditions. We're going to look at the industry. How are they doing? How is the revenue doing? How is their inventory moving? Etc., etc. And we will compare the industry and the client performance together to see maybe there's some issues with our client. Maybe some misstatement going on in really how well the inventory is actually moving in comparison to what sales that they're reporting. The regulatory environment, who regulates these folks? Is there an external company that regulates them? Are they paying their taxes on time? Do they pay what they're supposed to pay in taxes? Are they do they have an extremely high depreciation on their PP&E, et cetera, et cetera? So we'll look at that from a regulatory perspective. And then we will look at where we are in the economy. They're doing very, very well, and everybody else is not. So we would want to know why, from a financial statement perspective, is everybody else in their industry not doing as well as they are. We would look at that, what their interest rates are, and their availability of financing. So they did a lot of financing, but their interest rate is twice what a competitor would be in their industry. And then also, if it's the currency revaluation, remember we talked about a lot of places that actually use 2 or 3 different types of currency to purchase and or to sell their inventory. So we will look at if their valuation of that is correct and they're booking the right amount in whatever currency they're booking it in. Okay, very important. Assessing the risk of material misstatement due to error or fraud. So there's 2 different types of material misstatement, intentional and unintentional. Okay, so examples of misstatement include inaccuracy in gathering or processing data, a difference between the amount reported in the financials and the amount that would have been reported if it was done in accordance with GAAP, flat out omissions, and incorrect accounting estimates. So that would mean that either they did it intentionally or not intentionally. This would be the accounting estimates, or they did them very high for revenues, very low for expenses. We would look at all of that. Okay, errors are intentional, unintentional misstatements. Okay, mistakes, unreasonable accounting estimates, which would come from management, and mistakes in the application of accounting principles. They just really didn't know how to record a certain transactions or what account classification to record it in. Okay, fraud. Okay, remember we're looking at errors and fraud. Okay, errors would be unintentional. Fraud involves intentional misstatements. Okay, the fraud risk identification process is sources of information about fraud, communications with the audit team, inquiries of management and employees. We would do analytical procedures, which means we would actually test the transactions that we suspect of having fraud, and then unexpected period adjustments. So something, the statements come out, the accountants do the work, and management looks at it and say, no, you have to change this. So we change, we find that sometimes the internal accountants will change year-end adjustments because of the bottom line. Okay, audit risk. The risk that an auditor expresses an unqualified, that's a clean audit, on materially misstated financials. Okay, this is at the financial statement level and at the individual account balance level. Okay, so the 3 conditions usually exist when fraud occurs. 1, an incentive or pressure to perpetrate the fraud. Remember the bottom line. An opportunity to carry out the fraud. The internal controls really do not work. They can be overridden. And the attitude or rationalization to justify the fraud. When we tell management about it, and they say, hey, you know, we were supposed to have a 12% increase in our net income. We only had an 11% increase. We were able to take some expenses and change the adjustment to January, and we thought that was feasible based on XYZ. So we look at that, and this is how we're going to continue to assess material misstatement. Okay, fraudulent financial reporting, the risk factors relating to incentive and pressure. Excessive pressure for management to meet a third-party expectation, the shareholders. Financial stability or profitability is threatened. Say, for instance, like with Enron, when they did the additional split, okay, it was getting to the point where stock was not going up like they wanted it to go up, so they split. Okay, management's personal financial situation is threatened. Say, for instance, for meeting a certain revenue projection, management gets a certain amount of bonus because of that. If we look at the employment contracts, we will find out that information. Okay, risk factors related to opportunities. Okay, so the nature of the industry. okay? The operations that they actually are performing. They're complex. The there's only one or two people that actually understand how to record. There's a very small accounting department, or maybe a one-person accounting department, so that provides opportunity. The organizational structure itself is unstable or complex. Ineffective monitoring management, internal controls, they're never monitored or reperformed by any outside entity, or even internal auditors do not monitor management and their activities. And lastly, the deficient internal control. It just does not work. When opportunities are present for an individual to override the controls, that means that they are deficient, and that could be a weakness. Well, actually, that is a weakness. Okay. And then risk factors for attitudes and rationalization. So this is the last one. Use of inappropriate accounting based on materiality. Okay, so for the materiality for last year, remember I gave the example of if materiality was set, say, at $100,000, then most transactions in the accounts that actually have the fraud or the errors in it are accounts that are going to be less than materiality. Committing to aggressive or unrealistic forecasts. Say management comes down and says, okay, we got to have a 22% increase in net income this quarter or whatever to meet our shareholder expectations, and management says, oh yeah, we can meet that, and we look at it and they've never done that before, so they have committed to aggressive or unrealistic forecasts, so they have to do something to make sure that they meet that. Poor communications for reporting inappropriate behavior. There is no whistleblower 800 number. The accounting people feel uncomfortable about the risk of losing their employment if they say something to the audit committee, etc. And weak ethical standards for management behavior. Our management, and we can literally assess that during the beginning when we are deciding to continue with the engagement, just by speaking with management about issues and so forth. Okay. Fraud involves intentional misstatements, fraudulent financial reporting, and misappropriation of assets. Okay, so that's self-explanatory. Okay. Fraudulent financial reporting includes acts such as manipulation and falsification, misrepresentation in the financial statements, and intentional misapplication of accounting principles, like, for instance, goodwill. Okay, misappropriation of assets, really self-explanatory. Stealing the assets, paying for goods and services not received by the company. Remember, we were talking about in class one person putting a false address in the vendor file and actually buying services and sending checks to the falsified address, and then of course embezzlement. Okay, the risk assessment. Okay, assess the risk of material misstatement at the financial statement and assertion level. That's overall. Financial statement level risk. Do these risks relate pervasively to the financial statement? If yes, we develop an overall response. Okay, so we make a written response to management. Okay, so do they relate pervasively to the financial statements? No. We determine what can go wrong at the account or assertion level. Okay, so if they don't relate, then we would determine what ifs at the account assertion level. So the summary. So do these material misstatements actually negate the assertion that management has made? You remember occurrence and presentation and disclosure, so on and so forth. Okay, and then after we do that, then we design the audit. If they do, we got to go talk to management. Okay. To respond appropriately to financial statement level risks, the auditor may do the following. Emphasize to the audit team the need to maintain professional skepticism. So basically, we're going to look at something and say, if this is correct, then okay. But if it is not, these are the things that are going to be affected by this misstatement. Okay, that is what professional skepticism will get you. Okay, assign more experienced staff for those with specialized skills. Let's say we believe at the revenue account level that at the transaction level that there may be issues with revenue because of huge unearned revenues, and then at the end of fourth quarter, then the majority of unearned revenue has actually been booked to revenue. So as part of the adjustments, so we may need to have auditors that have either audited revenue accounts from a more detailed level than maybe non-experienced graduate level accountants that have a more overall view of testing. Provide more supervision, put more seniors on it, or have seniors to be in the engagement more time than generally was expected during the engagement process. Incorporate additional elements of unpredictability in the selection of audit procedures. Okay, so from a statistical perspective, we're probably going to sample more. We're going to sample more in accounts that we generally would not sample in, or have a increased amount of sampling. Say for instance in cash, generally it's not a whole lot of sampling in cash. Maybe there is an issue with our revenue, so we're going to look at cash just to see if deposits and outflows match. Okay, here's the risk model. Okay, so we have inherent risk and control risk. Inherent risk and control risk differ from detection risk. Okay, in that inherent risk and control risk exist independent of the audit. The levels of inherent risk and control risk are functions of the client and its environment. The auditor has no control over these risks. The auditor can control detection risk through the scope, the nature, the timing, and extent of the audit. Okay, so we can increase these things to lower our detection risk. Okay. Detection risk has an inverse relationship with inherent risk and control risk. Okay, so we look at the model here. We have audit risk. Total audit risk is equal to inherent risk and control risk times the detection risk. Okay. You don't have to remember this equation, but you need to remember the definitions and how they work of inherent risk and control risk, and there's absolutely nothing that we can do about this. Okay. Okay. After we complete the audit, then we consider whether the accumulated results of the audit affect the assessments of the entity's business risk or the risk of material misstatement, and whether the total misstatement caused the financial statements to be materially misstated. Okay, and that's at the account level. Okay, if the financial statements are materially misstated, then we got to request management to eliminate the misstatement. Okay, if they do not make the adjustments, then we should issue either the qualified opinion or the adverse opinion. Okay, so either we can issue the qualified opinion will say, okay, yeah, everything else is fairly represented except for this item, and then an adverse, of course, that the misstatement is so great that the statements cannot be relied upon. Okay, if we determine that the misstatement may be the result of fraud, or we have determined that the effect could be material, then we have to attempt to obtain audit evidence to determine whether the material fraud has occurred, and if so, how does it affect the statements? Do the statements need to be redone? Okay, or do we need to go back in prior years, and there may need to be some restatements done in prior years because of this? Consider the implications for other aspects of the audit. Discuss the matter and approach to further investigation with an appropriate level of management, which would be the audit committee. And then suggest to the client to consult with legal counsel if that is appropriate, and then consider withdrawing from the engagement. Okay, our documentation. Okay, all of our discussions, and we document everything that we do, so just know that. Any discussions we have with our personnel, all procedures that we performed, every single thing that we touched, every single thing that we looked at, the risk of identifying material misstatement due to fraud, and a description of our response. Okay, what do we think the effects are? any fraud risk or anything else that we believe that management needs to know, and if there's any additional work that we need to do, and the nature of the communication about the fraud made to management. So how did the conversation go? What did we say? What did they say? Kind of thing. Okay. Whenever the auditor has found evidence that fraud may exist, okay, we have to go to management immediately. Fraud involving a senior management person, okay, which causes material misstatement, should be reported to the audit committee. Okay. So we can report all fraud instances or material misstatement instances to management, and they will tell us who to report to. The audit committee will do that. If it involves somebody in that level of management, we have to go straight to the audit committee. Okay. Disclosure of fraud to parties other than the client, senior management, and its audit committee ordinarily is not, remember, is not part of the auditor's responsibility and is precluded by the auditor's ethical and legal obligations of confidentiality, except when the following conditions exist. We do not have to tell anybody anything outside of the audit committee, except to comply with certain legal and regulatory requirements when SEC says so, pretty much. To a successor auditor when a successor auditor makes inquiries of the predecessor auditor. So we would tell a successor auditor about it. In response to a subpoena, if our working papers are subpoenaed, of course, we would have to hand them over. To a funding agency or other specified agency in accordance with the requirement for the audits of entities that receive governmental financial assistance. Again, that would be a government or regulatory agencies. These are the only 4 times that we are required to give up any information. We do not have to give up information about or to media outlets, to the IRS, or anybody like that. Okay, so that is the end of chapter 4. You may take notes and have these notes available for testing. We will test the information that is provided in this video.